Hello, today is the 11th of June 2011, and in this video we're going to primarily look at the silver market using the 5-day moving average. And the summer of 2010 is what we are looking at. We'll go all the way upwards to where we are today. And the 5-day moving average, generally speaking, when it's in a trend, it's going to stay within that trend usually from 3 to 9 weeks. It can be less and it can even be later, but generally 4, 5, 6 weeks is the most common time frame a market is in one direction. It can either be bullish, bearish, or neutral. When you're in a situation where the markets go below, above, below, above, below, that's as neutral as you're going to get. It's going to show a lot of indecision, and you are only seeing the tail end of the neutrality that was being faced upon the silver price for almost a full year. On the earlier part of May, right before the flash crash in 2010, around the 2nd or 3rd of May, the silver price went up to 1975, and it crashed down pretty hard back down to the 17 levels, and it kept going in this sideways motion. And even in May, it was at a neutral state. So it was in this long range for quite some time. It ultimately broke out big towards the upside. But when you're looking within the 5-day moving average, and you see in a situation where the market's going higher, you want to find support at an area, establish a trend, it doesn't happen. Okay, that's fine. Now are we going to go in a bearish trend? We established a resistance, or support, excuse me, and even a lower one, and it's now moving up to the 5. Okay, so now you want to find resistance, break the level, that will confirm a downtrend. No, that didn't happen. Okay, so now we're going higher as we're moving in here, and now we want to confirm an uptrend. We've already created this resistance. We're now back to support, and we go higher, back again, and it doesn't hold. Well, that didn't confirm, and now you break below the support level, finding resistance at previous support, and you're up to the 5. That's fine. Now if you break down, you're bearish, but no, that didn't happen, and you break out, you find support, break above this high, and you're good to go. Well, it didn't break above it, didn't hold. Then you have another bear trap below. It finally broke out. And it was an interesting day when it broke out. This was on the 24th of August. And this is a pure example of whatever you're looking at, the trend's going to change. So if you're seeing a neutral market, you know it's not going to stay neutral forever. It'll go up, it'll go neutral, it'll go down, up, neutral, up, down, neutral, up, all this type of stuff, back and forth. Trends will always change. But there was a specific trend that was significant on that morning. On the blog, I had the silver chart up, and I was stating volume is huge today. While we are seeing the Dow once again below 10,000 for a brief moment, silver is going higher on massive volume. Because this volume is really large, this is a rally I would consider to take seriously. Larger volume can often spur the start or end of a rally/sell-off. Because this happened at the lower end of the range, this is one that I would consider to have some validity to it, that could trigger a nice intermediate term bull market that may last a few weeks, that can get us past the May highs. Well, it obviously got us well past those May highs in many few weeks. But what's interesting was this was the volume that it had. It's well, you can see here 5.6 million. This was for the first 30 minutes. Excuse me, first hour. This was the first 60 minutes from 9:30 a.m. to 10:30. And all of these previous days at the time were a million and change, maybe 2, and the daily volumes were 4, 5. So it already had more than what they pretty much got. Going into that day, the average for this was around 2 million, and the average daily volume was 6.2 million. So it was almost at the daily volume. Now the volume didn't end up going as high. It only finished at around 9-10 million. But it was something that did spark the rally. Now notice where I did state, this is huge. Well, let's take a look at the first hour of volume today. Last week, on Friday, there was 12.7, which is more than double. Higher, well, Thursday, this is one of the very low volume days we've had in quite some time, and it was still higher than that record breaking day back on August 24th. Wednesday, 7 million, 9. And this is a low volume period. And I say this because low and high volume are all these numbers is relative to what it's experienced before. So back then it experienced lower moves. It was higher. Here it was experiencing much lower numbers. It did the first week of May. 49, 42, 42, 74, and 67 million the first hour. And this was the bar setting volume, which is an insane amount of shares to begin with. But again, that's just another story. So let's now move back to the charts. We'll now focus on the actual rally itself. We'll move to the next one. And this was the rally. This spanned 15 weeks or so. So I can state, yeah, it's usually between 3 and 9 weeks. But this is an example of showing there's no such thing as going up too much, too long. The markets will correct themselves when they are ready to. And this was textbook economics. Well, textbook trend analysis. You can never, ever be in such a nicely organized range as we had seen in here. In fact, this is a trend line that I'm following to this day for parabolic moves. A confirmed break above this line. We came close at the start of May, end of April, when we hit $50 an ounce because it hit the top of this line. But when it originated, it got above it briefly and found support at this 5. We'll get to the 5 in just a moment. Then again, finding support but not holding. So sort of like on the last chart, it was showing indecision. At this point, it was showing indecision on whether it wanted to break out or break down because it broke down a few times below here and didn't hold. It had a nice breakout here where it had a huge gap above it. And this makes it easier to find resist or support at this level and make the parabolic move because you can afford to come back to 29, back down to 26 and change and still stay parabolic, at least for the short term. And it happened. It held the 5. That's fine, but it didn't break out from here. It didn't go parabolic. So it went from going parabolic, unconfirmed, to a confirmed uptrend. This was going back to confirmed uptrend. Now it's trying to break down in here. No. And within the 5-day moving average, it had some fake outs. But I want to explain what happened every single time the 5 came to it. Because before, support everywhere. I can say the more often support's tested, the more likely it has of breaking down. But that doesn't mean it always will. It did break below here. So now what we need to do is confirm a break below here. And it finds resistance here, unable to do it. There's the failed move. There's the fast move. And there was a support test as the fast move was getting going. Again in here, it breaks below the 5-day moving average. It didn't find resistance here to trigger an intermediate downtrend. And it wasn't long enough for me to consider this neutral. As it got above it, found support, got above it, it sort of found support, but it went below it, went above it, and now finding resistance. This is ultimately here where the market topped. So the bull market on the intermediate trend started on August the 24th and it ended around the 4th of December. That was an extremely long bull market. Now after this had occurred, that's when we went within 2 different trends. One was neutrality, and then it was bearish. The neutrality was the month of December. We had them top at market top, go below this market, above, below, above, and now it's trying to break through. And even though it technically made a new high by inches, it didn't find support where it was supposed to. And even it could have found support here, went higher, whatever. But Instead, it came above this level, so thus it ended up finding resistance. It found resistance again, so it broke by this level and had at least one significant wave lower. That's enough for me to consider this to be an intermediate trend lower. This started the first week of January, it ended the third week, therefore it was a 3-week intermediate trend towards the downside, because this ultimately here was when the market bottomed. It bottomed at $26 and what ended up being 30 cents. Again, this happened on the non-New York time frame, so it bottomed here at 26.30, and then it had a beautiful update on the Friday, and that's when the market again got bullish. And this one was for about 3 months. So again, it broke that 9-week high level. 3 months is about 12, 13 weeks. And there was only one fake out along the way. Support, support, support. This isn't really much of a fake out. It's a short-term one, but it was still support. You had support, and then here was the only fake out because it found resistance at the 1 in here. It did technically make this lower low, although not really, but it didn't find resistance here, and it also wasn't long enough to consider this either neutral or bearish. Therefore, I consider it support with a fake out. Question is this a failed move? Well, it had a fast move to get into the upside. And within that fast move, it found support at the 5 on 1, 2, 3, 4 different occasions successfully. And then the market ended up topping. I've went through so many different trend line analysis within this. I'm not going to do it again. But when you get to these types of levels, it really does spell roller coaster one way or another. That roller coaster ended up going back down to 32. It could have very easily got us up to 75. However, because this trend line did start to roll over, we can now take a look at the current one that we're in, which has already had a downtrend lower. Now, you can almost state, well, you had this level of support, which you really didn't break down. And in some cases, you have to state, well, when you're down from 50 to 34, where it bottomed here, that's just flat out a market crash. Thus, it's bearish. And now we're getting a situation here where we were below the 5, we went above it, we went below it, we went above it. It's showing a lot of signs right now for that of neutrality. Therefore, as far as looking for breakouts and breakdowns, the most easiest way of doing it is establishing what the range is, and the range is from the highest point to the lowest point. As long as it stays within that range, then it's going to be neutral. After all, if it's ever going to get bearish and we're going to see 80, what's mathematically guaranteed is a break above this range. If we're going down to 25, what's guaranteed is a break below the range. So if you're looking to play one side or the other, if you play breaking the range, then you can at least manage to get in on high gains without missing the boat. Because there's a lot of people along the way when we were seeing these massive gains. We'll just go back to that last chart. When we were seeing these gains, that they were waiting for a pullback. This pullback wasn't big enough. And by using the 5, you're right, that never happened because you never got a breakdown below this level. Well, if you're waiting for a pullback, you got it. So now if you're playing for that wait, that either means that you are waiting for a significant level. When you're at 50, what's that pullback going to be? You could have been waiting for a pullback at 27, 28, and now you're forced to get in at 34, 35. That happens when the rally goes up really big. After all, if it would have went up to 100 without much of a pullback, now you're hoping to get back in at 60. That's the market dynamics that I look at anyway. So therefore, if you have a price target of 29, something that hasn't hit yet, and it doesn't get there, then that's really what's missing the boat. Because if you wait for 29 and it just skyrockets back up again because it never goes there, then that's majorly missing. If you're waiting for a breakout confirmation to the upside, it's impossible to miss the boat. And the only way it's possible is if they really hit you hard, and that is they gap the market up to $90 overnight. That's unusual, unrare. It's probably going to do its normal technical trading, break resistance, find support at resistance, all those key different variables that you're looking for. Okay, thank you everybody for watching this video, and have yourself a magnificent weekend. Bye-bye.